Today we'll be starting with value of business, okay, valuation of business, okay. So how do we do valuation of business? Okay, this is a chapter of your CA final, that is valuation of business, okay. So let's start it, okay. Let's start with an example for a better understanding. Why is valuation of business done? Okay, let's suppose this is a person called as Alex, okay. Now he wants to buy Tata Motors, okay. He wants to buy Tata Motors. Now this is an individual person, okay. He has very much money, okay. He's an HNI, okay. He's an high net worth individual, okay. He wants to buy Tata Motors, okay. He has both paisa, okay. He wants to buy Tata Motors. Then Tata Motors is quoting a price, okay. If you want to buy, give me 30,000 crores. Okay, so I am saying, Alex is saying that why 30,000 crores? Okay, this is not the fair value. Let's take fair value. Okay, so Tata Motors is asking is how much are you willing to give? Okay, so I'm saying, Alex is saying that let us hire a valuer, okay, and we'll value your business, okay, and then I'm ready to pay the amount. Okay, it should be fair deal. Okay, so now we are going to see this transaction, okay. So what is the valuation of this business so that Alex can buy Tata Motors at the fair value price, okay. So why is Alex willing to buy it? Because he wants to do merger and acquisition, okay. He wants to acquire Tata Motors. Next, why is Tata Motors want to value the business? Because it wants to do sale of business. It wants to sell its business. Next, another thing is for strategic decision making. Okay, this we will see later part of the chapter. Next, so there are some methods. Okay, so before finding the methods, we will see basics of it. Okay, value of firm that is your enterprise value or your value of business. Value of firm is equal to value of equity plus value of debt minus your surplus funds, okay. Why is this minus surplus of funds coming here? I'll explain it to you in a while, okay. See, let's see, I want to buy Tata Motors, okay. Let's suppose I am ready to give 25,000 crores, okay. So 25,000 crores for what? 25,000 crores for his balance sheet, right? For his balance sheet, assets and liabilities, right? For everything I'm paying, right? For everything I'm paying, okay. I paid the amount. Then what happened? I opened the locker, okay. I opened the locker of the firm. Then I found cash of 2 crore rupees, okay. I found cash of 2 crore rupees. Now this 2 crore rupees is my lottery, okay. Now this 2 crore rupees is my lottery. I bought all of their assets and liabilities, okay. So everything, that is their plant and machinery, their existing inventory of cars, okay, everything is mine, okay. So whatever I get in the business, it is mine. So I opened the locker, I got 2 crores cash, okay. So that is mine, okay. I'll tell you another example. Have you seen in History TV 18 storage wars? Okay, they buy a storage by just looking at the outer part of it, okay. They look at the outer part, they are not allowed to examine, okay. They just look from outside, okay, and then they buy the price, okay. They auction and they buy it, okay. And sometimes from that storage they get very much valuable things, okay, and they sell it in the market and they become rich, okay. 2 times profit, 10 times profit, 50 times profit, okay. So like that they do. So whatever they are getting from that storage is theirs, okay. They are just paying for the storage unit, okay, and whatever is being realized from that is theirs, right? So here also same thing happens, that they are getting something from the business, okay. Everything they bought the business, and whatever they find in that, it's their profit or loss, okay. So the same logic is being applied here also, the storage was thing. Okay, so that's why what is happening is that I'm buying equity. Okay, but in there, in the firm there will be some debt also, right? Long term debt, okay, like your debentures, okay, and your current liabilities also, okay. You have to pay all of them, right? You have to pay all of them, and that is, you have to pay your creditors and the long term creditors also, okay. Down the line you have to pay them, okay. So this is also forming the value of firm only, okay. For that also I have paid the value, okay. For that also I have paid the value, right? So why are we doing minus surplus? Because I have paid a certain value, right? Let's suppose I have paid 25,000 crores. Since I got 2 crores bonus, okay, from the bank, from the locker, I didn't have to do any mehnat for that, okay. So I got just 2 crores just for that, just like that. So that 2 crores I'll deduct from it, okay. A rupee saved is a rupee earned, okay. A rupee which you get from somewhere, okay, which you have found lying on the ground is yours, right? So like that, the same logic is being applied here, okay. We will do minus surplus funds because it is in cash. It will reduce my purchasing price, okay. Now my effective price is what? 24998, right? 24998 crores, okay. Next, value of equity. You just have to use this formula only, okay. Next, value per share. What is value per share? That is your value of equity, okay, divided by number of equity shares, okay. So what value will you get? This is for the finding the value of market price, okay. For the finding the value of market price. Next, if there is no debt and surplus cash, then value of firm is equal to value of equity, because value of firm is equal to value of equity plus value of debt minus surplus funds. If I put 0 in value of debt and 0 in surplus funds, then what is remaining? It is only value of equity, okay. Very much simple it is. Next, cost of capital of the company, weighted average cost of capital. This we have already learned in CA Inter, right? So how do we calculate it? We find the weights, okay. We find the weights of equity and debt, and we'll multiply it with the cost, okay. What is KD? KD is post tax debt, okay. It is post tax cost of debt, right? If the value cost of debt is, let's suppose, 12% and the tax rate is 30%, so what we do? 12 into 1 minus t, 1 minus 30%, right? Because interest is a tax saving expense, so that's why we do post tax, okay. And what is weight of equity and weight of debt? Weight of equity is E divided by E plus D, and debt is equal to D divided by E plus D, okay. Now a thing might arise in your mind, that why are we not doing D into 1 plus 1 minus D? Because we have already given effect in this rate only, okay. So we need not give it here. If we are not taking it here, we can take it here, okay. If we are not taking in cost of debt, then we can take it in weight, okay. This is just mathematical, okay. Next, equity share plus equity is equal to equity share plus surplus plus intangible asset, that is your patent, which is not recorded in the books. This is very much important, that is, which is not recorded in the books. Next, debt is equal to long term debt, okay, like your debentures, long term loans, borrowings, bonds, whatever. Companies also issue bonds, okay. If there is a long term debt but cost of debt is not given in question, then calculate cost of debt using CAPM. Okay, you can find it by using CAPM. This CAPM is only for security, but we can also find it for a company, okay, when there is no information given. Okay, so how do we find it? RF plus beta of asset, okay. In previous chapter, okay, in portfolio management, I think we learned about beta of asset, right? The same thing is here, okay. Asset beta into RM minus RF. What is asset beta? Asset beta is your company specific risk, Okay, company specific risk in a particular industry. RM minus RF is your rate of return in the market, minus your RF is your risk free return in the market. Okay. In general, we do not apply CAPM formula to calculate WACC, since WACC will not be the same from both the formula. Okay. So how do we calculate WACC? This formula, right? KE into weight of equity plus KD into weight of debt. But this both will not be equal. Okay. So that's why we'll not use the same formula. Okay. We will not apply. But if there is no information given, then we will apply. Next, we'll move on to our example only. Okay. So what was the last line? Okay. Now Alex is saying that let us value your business and arrive at a conclusive price. Okay. Now they want to do valuation of business to arrive at a conclusive price. Okay. So now they have added a business value, right? Let's suppose CAX. Okay, CAX they have hired. Okay. They are asking questions that how will you value it? Okay, now he is giving options. First option is giving that let's try the MPS method. Okay, market price per share method. Okay, so what is he saying that Tata Motors, tell me a number of shares. Tata Motors is saying, let's suppose 2500. Sorry, 2500 crores. Okay, 2500 crores he's saying. Next, he's asking what is your market price per share. Let's assume it is 25 crores. Okay, now this is just an hypothetical example, don't correlate with the actual market. Okay, now he's asking what is the price in the market. Tata Motors is saying it is currently trading at this price. How much? Let's suppose it is currently trading at 900 rupees. Okay, but it is not right. No, now it is facing downfall. I also hit the 52-week high last week. Okay, so last week my price was 1150. Okay, how can you value it at 900? Okay, so what we'll do is that when there is a thing arising like this, we'll do average. Okay, so since here they have Tata Motors has given an average price. Let us assume he has given an average price of 950. Okay, this is an average price, we'll assume. Okay, now 25 crores into 950. Okay, CX is saying that to Alex, pay 25 crores into 950 to him. Okay, how much is it coming? 25 into 950. It is coming to 23,750 crores. Okay, Alex is very much happy. Okay, he asked 30,000 crores, but only 23,750 I have to pay. Okay, it is okay for me. But Tata Motors is saying wait. This is not thing. There is a limitation here. Okay, there is a limitation here. People have plummeted my stock to a certain level. Okay, my stock was actually valued 1 to 2 years back. It was 2,000 rupees. Now it is only 950 rupees. This is not fair. Okay, this is not fair, because the traders have sold it now, but they might buy it later, no, and the price might increase. Since market price is determined by demand and supply, it will not reflect a good pattern. Okay, that is what Tata Motors is saying. Okay, since demand and supply is the driving factor of market price. Okay, so 950 is not a fair value. Okay, now the market is down. Okay, 950 is not my fair value. My share value should be 2000. Okay, now Alex is saying no. How can it be 2000? Okay, I don't know that. Now give me the current price only. Okay, they did not agree. Okay, so we approached CX and we told him that give us another method. Okay, the next method is that market price method. Now he gave another method. Okay, he gave a method of P ratio. Okay, P ratio method. He gave another method of P ratio. Okay, what is P ratio method? P ratio method is price earning per share. Okay, P ratio into EPS. Okay. Then Tata Motors, okay, and he gave another formula, that is P into EAES, okay, earnings available to equity shareholder. The both are the same, okay. P ratio into EPS, it is for individual, and this is for whole, okay, whole amount will get, okay. Now CX gave this amount, okay, they gave this formula, okay, and Alex was fumed, okay. Alex was Tata Motors was very much angry, okay. Why? Because Tata Motors said you already gave MPS formula, okay, market value per share formula, okay. Now what you are doing is that you are giving me the P ratio. What is P ratio? P ratio is price, that is market price, upon my EPS. Okay, you are anyways using my market price. This you will get market price of equity share only. Okay, so this is the same method only. Why are you giving the same method? Okay, that is who is asking? Tata Motors. Okay, now CX is saying, okay, sorry. I'll come tomorrow. Okay, and I'll give you next method. Okay, so next day, CX comes and he gives another method. Okay. He is coming with a great method now. He went home and he thought about it, okay, and he came up with the method, okay. So what is he saying? That we'll do net asset method, okay. Tata Motors is asking what is net method asset, okay. What is net asset method? It is your equity shares plus reserves minus any contingent liability, okay. Equity shares plus reserves minus any contingent liability, okay. Let's assume this is not here, okay. Now Tata Motors is asking what is this, okay. He is saying that it is total assets. What is total assets? Total assets is fixed asset and your current asset, right, minus your total liability. What is your total liability? It is your long term debt plus your short term debt, okay. Or else what can I say is that long term debt plus your current liability, okay. Long term debt plus your current liability, okay. So this will not include my equity shares and reserves and surplus. If you see, this is my balance sheet, right? This is my asset, okay. My asset will be total here, okay. My liability, okay. So now what we are doing is that here current asset plus fixed asset minus my long term debt plus this thing, what, current liability, okay. Because why we are doing this is that how much asset am I having minus my total liability, okay. I have to eventually pay my long term debt and my current liability, okay. Equity shares I'm not going to pay anytime, okay. Equity shares I'm not going to pay anytime. It is my money, okay. That is Tata Motors money. It will never pay them, okay. And reserves and surplus, they have earned for so many months, okay. Now it is keeping it with it, okay. So now equity share capital and reserves and surplus, right. So they will not pay. This is their money, okay. So what is the value of business? Either total assets minus total liability or equity shares and reserves and surplus, okay. Now again Tata Motors is fumed, okay. What is Tata Motors saying is that it is saying how can you do it, okay, since it is in okay, not Tata Motors, okay. Now Alex is saying, what is Alex saying is that, okay, I'm willing to pay, but how much is it coming? It is coming to, let's suppose 31,000 crores, okay. Now Alex is thinking hard. Okay, equity shares plus reserves and surplus is 31,000 crores. Now Alex started to read the financial statements. Okay, and he found in the footnote, in the notes, okay, notes accompanying the balance sheet and P&L, he found that there is a contingent liability. What is a contingent liability? Contingent liability is a liability which can occur, okay, in the future. Okay, there is a possibility that it can occur. Okay, so they have noted it down there. Okay, now Alex wants to be 100% sure. Okay, if tomorrow this contingent liability, that is, a case is going on Tata Motors. Okay, a case is going on Tata Motors. That case, they are on the verge of losing it. Okay, so if in the next year, if Tata Motors loses that case, and if Tata Motors sells it to Alex, then Alex will have to pay that amount, no? Okay, so now what is Alex thinking is that this contingent liability is, let's suppose 7,000 crores. Okay, 7,000 crores. Alex is saying is that since I have to pay that amount, okay, I'll pay less. Okay, there is a contingent liability and Tata Motors is seemingly to lose it. Okay, so I'll deduct this amount and then we'll give you. Okay, now the value has come down to how much? 31 minus 7. It is coming to 24 crores, 24,000 crores. Now Tata Motors is not happy. Tata Motors is thinking, no, this is not good. Okay, why is Tata Motors saying is that, see, now you are saying that 24,000 crores, okay, this is not a fair value. Okay, you have taken everything in my book value. Okay, in my book value you have taken everything. Okay, the assets in my company, okay, the assets in my company, they are not valued at a fair price. Okay, they are valued at book price. I have recorded it in cost only. Okay, so how can you say that my total assets is how much? 31,000 crores. No, it is not 31,000 crores. It is much more than that. I have applied, I have went on the conservative side. Okay, this is not fair value. This is a conservative approach I have applied and valued my shares, valued my fixed assets at lower price. Okay, so this is not fair value. Okay, so now what is CAX saying is that, okay, if you're not willing to do this, we'll take market value of it. Okay, we'll take market value of your shares. Okay, so what is he saying is that net asset method, what is he saying is that market value approach. Okay, what is the current market value of your price, of your equity of your assets? Okay, CAX is saying is that we'll follow market price only. Okay, we'll see how much your assets realizes in the market. Okay, realization method or liquidation method. Okay, since we are finding it as the price which will be at which it will be sold. Okay, current market price of all the securities, of all the assets in the Tata Motors. Okay, so now what they are doing is that they are saying take book value. Okay, now we don't have the whole time in the world to calculate net asset value method again. Okay, so what we do is that we'll take book value plus any item that in the book value, if any item yields more, okay, yields more than the book value, we'll add it, and whatever yields less than the book value, we'll minus it. Then we'll arrive at net asset value method. No, so let's suppose your land and building was valued only for 10,000 crores. Okay, your land and value building was valued at only 10,000 crores, but it is yielding more, 30% more. Okay, so we'll add just the 30% here. Okay, it was valued at 13,000 crores, so only 3,000 crores we will add here. Okay, and my inventory, okay, my inventory I have valued it at, let's suppose 12,000 crores. Okay, not 12,000, it will be less. Okay, 5,000 crores. But when I went to sell it in the market, no one was willing to buy, at the price. Okay, so its value was less. How much less? Okay, minus 5%. Okay, so I'll do minus 5% of it here. Okay, so this is realization value method. Now I will get my net asset at the market price, right? Now this value also came to, let's suppose, 26,000 only. Okay, now this value came to 26,000 crores. Tata Motors is still not happy. Okay, Tata Motors is still not happy. Okay, what is Tata Motors saying is that, see, this is not a limitation of Tata Motors. Okay, I'll take another example. Okay, limitation, I'll take another example. Okay, let's suppose a coaching industry. Okay, what will be the value of it? Okay, online coaching industry, what will be the asset of it, which it will be using? Let's suppose a camera, okay, a laptop, and a iPad. Okay, this is the maximum they can have. Okay, a green screen. Okay, everything value, book value will be how much? 2 lakh. Market value even less than that. Okay, 1 lakh only. So, but how much are they earning? Okay, in crores. Okay, in crores they are earning, but it is not in 1 lakh or 2 lakh. Okay, since asset does not depend. Okay, using that asset, how much earning are they doing? Okay, asset turnover is more. Okay, asset turnover ratio. What is your asset turnover ratio? Asset turnover ratio is your sales divided by total assets. Okay, how much will it be for a coaching industry? Coaching industry, it will be more than 20 times. Okay, 20 times the total assets they are using. Their earning capacity is more. Okay, by using the total assets. So will they be able to use this asset? Okay, will they be able to use this method, net asset method? Never. Okay, because their earning capacity is more. So what, this is a limitation. Okay, so that's why next method is going. Okay, they are going to, okay, Tata Motors, since he got less value, okay, he wants another method. Okay, he is very much salty. Okay, Tata Motors wants another method. He asks CAX to bring another method the next day. Okay, the next day, Tata Motors told to get another method. Okay, so what method is, we'll see. Okay, now first day CAX told the market price method, it did not work. Okay, two method he told, PE ratio and MPS ratio, it did not work. The second day he came with net asset method. Okay, book value and realizable value method. Okay, the third day is coming. Okay, now what was their limitation? The limitation was this thing, the asset turnover ratio. Okay, the earnings and earnings generating capacity. Okay, that was the main reason. Now CX thought about it and he came up with the next idea. Okay, he thought, why not take the earnings, okay, of the firm? Okay, why not take the earnings of the firm? So he used our very old Gordon formula. Okay, dividend growth formula. Dividend growth formula. Okay, he came up with the very old technique of Gordon, dividend growth formula. What was the formula of him? That is D1 divided by KE minus G. Right. So what does a Gordon by assumes? He assumes that our dividend is the sole factor for value of the firm. Okay, value of the share. Okay, so he came up with this method. Okay, D1 will be growing perpetually at this rate. Okay, it will be growing, let's suppose 2% per year. Okay, but the cost of equity is, let's suppose, 12%. Okay, so since it will be growing every year 2%, what is K? K is required rate. Okay, required rate is less. Okay, required rate is, let's suppose, 12%. Okay, but KE, the growth will be 2% every year. Okay, since it is growing 2% more, so why will I need 12%? I'll need only 10%. Okay, Okay, so that's why we have done KE minus G. I've already explained this in security valuation chapter. I did it again. Okay, so this formula, this is for perpetual growth. Okay, and next what he's saying is that since it is perpetual growth, we can also find it by this method. Which method? If you have if you are in the growing stage, okay, for 4 years you might be growing at a different rate, let's suppose 20%, and after that your growth will stabilize. Okay, that is you will grow let's suppose 10% or no growth. Okay, you will stabilize and you maintain the same level. Okay, so that's what he's saying, and he's saying that if there is a growth like this, okay, then we'll apply this time value of money. What we'll do is that we'll take discounting rate, and we'll do PV. Okay, PV of every year. Okay, we'll take a cash flow and we'll do PV of every year. Okay, what will be my cash flow? It will be my dividend only, I guess. Sorry, this is not the case here. Okay, this is the next method. Okay, he gave this formula. Okay, and what did he tell is that you will get the value of the firm by this formula only. Okay, if I take total dividend here, you will get total value of the firm. Okay, if you take per dividend, okay, dividend of 1 share, you will get of 1 share only. Okay, now what is DO? D1, it is DO into 1 plus G, right? DO is what? DO is your dividend paid during the year, and 1 plus G is your growth rate after merger. Okay, so he's telling that after you take over, he's telling Alex that after you take over this Tata Motors, it will grow by certain percentage. Okay, you will get synergy benefit, it will grow by a certain percentage, and you will take that growth percentage, you take it here. Okay, this will be my future cash flow divided by KE. Okay, your required return is, let's suppose, something 12%, and it will grow earlier growth rate, sorry, it will grow by 20%. No, so we'll do 20% next. Okay, so now what is KE? Here, if there is no debt, we'll use KE. If there is debt, we'll use KO, because we are buying whole of the Tata Motors, right? So we'll use KO here. So how will we find KO here? Okay, how do we find KO? First priority is by using CAPM. Sorry, this is equity only. There is no KO. Okay, there is only equity, because we are using dividend growth model. Dividend growth is only your equity. Let's suppose there is only equity shares in Tata Motors. Okay, so we'll use only equity here. Okay, so how will you find it? Using CAPM. This will be my first priority. Next method is my KE is equal to D1 upon CMP plus G. Okay, this is just derived from this only. Okay, how did I derive it? It will give my current market price if I take it one thing. Okay, if I transfer KE here, what will happen? KE minus G is equal to D1 upon CMP. Okay, if I want just KE is equal to D1 upon CMP plus G, right? This is the basic formula of it. Okay, next, this is the basic funda of it. Okay, this is my second priority. My first priority will always be CAPM. Okay, by using dividend growth, we will find the value of firm. Okay, now Tata Motors is again fumed. Is saying that I don't pay any dividend. Okay, I don't pay any dividend to my equity shareholders. Okay, I pay only less dividend, only meager dividend I give, but I reinvest in my business. My business grows. Okay, so this is not a proper method. Okay, dividend method. He's saying is that, what is he saying is that you have to take there is also some debt, okay, in the company. Okay, so debt value is also important. Okay, you have to buy them also, so you have to take that earning also. Only dividend is not your earning. Okay, only dividend, you are only considering equity shareholders. But what about the debt? Okay, so now he's trying to do, what is he trying to do is saying that take debt also. Okay, so for debt what we'll do, sorry, not debt, I'll explain it again, just forget it. Okay, the next method you just forget it, I'll just tell you. What is he saying is that I don't rely on dividend much. Okay, I don't give dividend much, but you have to take my earning capacity. Okay, earning capacity, and you have to do all the things. Okay, the next method is what? Earnings capitalization method. Okay, earnings capitalization method. So what it is, we'll see. In earnings capitalization method, value of business is found by what? Earnings value of the company. Okay, using the following steps. The first step is finding future maintainable profit. So what is the profit maintainable in the future? What is Tata Motors saying is that we'll be able to generate more funds. Okay, so how will we do it? Wait a second. So what is this method saying is that take my earning value of the company. Okay, so how do you find it is that Tata Motors said that my earnings of the company is my earnings of the company is, let's suppose, 2000 crores. Okay, my earnings of the company is 2000 crores. Okay, and we'll do divide by the KE. Okay, KO of the company, right? We'll divide it by the capitalization cost of capital of the company. Okay, let's suppose 2000 divided by the cost of capital of the company was 10%. Okay, was 10%. Okay, KO was 10%. Sorry, 15%. Okay, whatever it is. Okay, so he's getting value as, okay, whatever the amount here. Okay, he divided by KO and he got value as how much? 30,000 crores. Okay, equivalent to that. Okay, I'm not finding the KO value. Okay, the cost of overall capital was this much. Okay, and he got value as 30,000 crores. He wants 30,000 crores only. Who? Tata Motors. Now what is happening is that now Alex is looking at the balance sheet again. Okay, he found at this value as there is some extraordinary profit. Extraordinary profit is booked in the credit side of the profit and loss. Okay, he's asking what is this. Okay, he has found some item. Okay, and let's suppose it is sale of value of, sorry, sale of asset. Okay, profit on sale of asset. He's saying is that, are you doing profit, are you selling your assets every year? Now Tata Motors is saying no. Then why have you taken this into account? Deduct that. No, you are not going to sell your asset every year. Okay, so this profit you will less it. Okay, so Tata Motors agreed to it. Okay, and he deducted this amount. Okay, extraordinary profit was, let's suppose, 200 crores. Okay, he deducted this amount. Now Tata Motors is looking for another thing. Okay, he's saying is that, okay, you have deducted this. No, now the value is going more. Okay, the value is becoming less. Now Tata Motors is thinking of something else. Okay, he's saying is that if you are deducting extraordinary profit, I have also booked extraordinary loss. Okay, so add that also. What is extraordinary loss? There was a fire that happened in the one of the units. Okay, so I booked that also. The fire will not occur every year, no. So you take that also. Okay, so he added back that. Okay, extraordinary loss. Let's suppose 200 crores. Okay, now the value is equal. Okay, now Tata Motors is not that happy. Okay, he said that I have also launched a new product. Okay, I'll also be launching a new car. Okay, in the coming years, I'll also be launching a new car in the coming years. Okay, and it will be an estimate like it will sell for this much crores. Okay, let's suppose it will sell for 1,000 crores. The new car, the Tata Punch, it will sell for 2,000 crores, and we'll take that also. Okay, now Alex is saying is that okay, we are taking that, but we'll take only profit of it. Okay, less all the expenses, we'll take only profit of it. Okay, new product profit. Okay, we deducted what? We deducted from the sales. What we deducted? The material cost, labor cost, fixed cost, any other cost we deducted. Okay, and now what? And now they are deducting finally tax. Okay, now they are finally deducting tax and they are getting an amount. Okay, this is the future maintainable profit. Okay, now this amount is coming to, let's suppose 2,500. Okay, not 2,500, it is coming to 1,900 something. Okay, it is coming to 1,900 and divided by capitalization. Okay, and the value came to, let's suppose 24,000 only. Okay, now Tata Motors is still not happy. Okay, Tata Motors is still not happy. What is he saying is that what have you done? This is not correct. Okay, my earnings is not fine, because I will grow every year. Okay, I will grow every year. This earning is of current year only. No, I will grow every year. There will be future cash profit in the, my business will grow. Okay, I'm in the growth stage. In years to come, I am expecting every year to grow as 20% for the next 4 years. Okay, and then my earnings will stabilize. Okay, so we cannot take this earning of current period. Okay, we have to take future profit. Okay, so he told that. Okay, then we got another method. Okay, that we'll discuss in next lecture. Okay, for this lecture this is enough. Okay, earning capitalization method was my last method here. Okay, so now this 2,000, what is this 2,000? 2,000 was the profit, but which profit? There is many profit. Okay, profit before tax, profit after tax, earnings available to equity shareholders. Which profit? Profit, what profit? It is profit before tax, because we are finding the value of firm. Okay, and not just of equity, we are finding value of firm. So we are taking profit before tax. Okay, so why did we not deduct interest here? Why did we not deduct interest here? Because when we do KO, right, when we do KO, what we do, weight of debt into cost of debt, weight of equity into cost of equity. In weight of debt or your cost of debt, what we do is that we do 1 minus t. Okay, let's suppose your rate was 12% and your tax rate was 30%. We do 1 minus t, 12 into 1 minus t, right? We are getting we have taken effect of tax already here, so we need not deduct interest and tax interest, so we need not give tax benefit here. Okay, since we have already taken in KO. Okay, so that's why we have not taken your interest benefit here. Okay, so we'll take profit before tax because it is for everyone. Okay, it is for everyone. It is for the value of firm. Okay, next lecture we'll see cash flow method. We have some questions here. Okay, in the earlier part, we'll do that. See, we have the following questions. The first 3 questions are very much easy. You can do it, okay? But I'll just explain it to you once. See, the balance sheet of HK Limited is as follows, okay? They have given some values here. Non-current asset, current asset is given here, and the shareholders fund is given, long-term debt is given, current liability and provisions are given. Okay, the total shares, the shares are actively traded at, and the current market price is 12. Okay, the shares are actively traded and the current market price is 12. Shareholders funds represent 70,000 shares plus of rupees 10 each, and the rest is retained earnings. Calculate the enterprise value. Okay, so now which method to apply here? There is nothing given here. Okay, you just have to look the data here. Okay, and then you have to apply a method. What can it be? The first one is book value method can be done, right? That is your 800 only. Okay, your shareholders funds, that is your reserves and surplus plus your equity. Okay, that method can be followed. Next, what method can be followed? Your current price method can also be followed. Okay, market price of the share can also be followed because market price is given and 70,000 shares is given. So what will you do is that we'll find we'll take value of firm by this method. First, value of market price. Okay, so how we'll do? 12 into how much? 70,000. I'm getting it as 8,40,000. It is in thousands, okay? So 8,40,000 value I'm getting. Okay, we will use market capitalization method only. Okay, so in market capitalization, we have taken value of equity. Okay, now we have to take market value of debt also, no? So market value of debt, they have not given any information here, since market of debt doesn't change, okay, much. The book value represents the market value also, so it will not change. So how much is it? The market value, it is 200 lakhs. Sorry, 2 lakhs, right? Long-term debt is 2,000, okay? It is 10,40,000. Now, this is my value of firm. But is it right? I've bought the HK Limited, but there is some funds kept in the locker, that is 500, okay, minus 5 lakh, okay, my surplus cash. Okay, so what is my value of firm? 5,40,000. Okay, 5,40,000. Now here you see that 70,000 shareholders represent 70,000 shares of 10 and rest is retained earnings. So why did we not take retained earnings? Because this price of 12 includes the value of retained earnings also. Okay, market price includes the value of retained earnings. When you buy the equity value of equity value shares, when you buy the firms, okay, then at market price, we are assuming that this market price represents the value of retained earnings also. This price reflects the retained earnings price. Okay, so that's why we did not take retained earnings. Okay, next. It was a fairly easy sum. Okay, just keep the concepts in mind. Snake Limited is taking over Lizard Limited. Both are listed companies. The PE ratio of Lizard has been low as 4 and high as 7 and is currently 5. Lizard's previous year was 3.40, EPS was 3.40 and current expected EPS is 4. Determine different range of values using PE method. So what are they asking is that we have to find out 3 EPS. Okay, three levels of EPS are there. Sorry, 3 levels of PE ratio is given and 2 EPS is given. Okay, so we have to find it using a table. Okay, see here, historic EPS is given and expected EPS given. Historic EPS is 3.40 and expected EPS is 4. And P ratio, lowest, current and highest. For 3 values we have to find. It is very much easy. It will not be asked in question in exam. Okay, so skip it. Next. Sun Limited recently made a profit of 200 crores and paid out 80 crores, slightly higher than the average paid in the industry to which it pertains. Okay, so 80,000 dividend it gave. The P ratio of this industry is 9. The estimated beta is 1.2. As per the balance sheet, the shareholders fund is 450 crores and the number of shares is 10 crores. In case the company is liquidated, the building would fetch 200 crores more than the book value and stock would realize 50 crore less. This is somewhat similar to our net asset realization value method, right? So they will ask, we'll see. The other data given is as follows. Projected dividend growth is 4%, risk-free rate is 6%, market rate is 11%. This will be used for my CAPM equation. Next, calculate the valuation of Sun Limited using P ratio. Okay, so how do we use it by P ratio? P ratio is given in question. Yes, it is 9. What is the EPS? EPS is not given in question. They have given a profit of 200 crores. We'll assume it as earnings available to equity shareholders. Okay, 200 crores is given and value of number of shares is given as 10 crores divided by 10. So what is the value of my one share? It is 20. Okay, 20 into how much? Calculate the valuation of Sun Limited. Okay, we are doing valuation into how much? Into 9. Okay, so 180, right? So this is my one share price. Okay, so how much is the total? Into 10 crores. So it is 1800 crores. Okay, 1800 crores is my value as per P ratio. Okay, we are finding total value. Next, dividend growth model. What is dividend growth model? It is D1 upon KE minus G, right? So what is the dividend? Dividend was given 80 crores. 80 divided by 10 crores. It is 8 rupees. Okay, dividend was 8. Next, into how much is it growing? Into 1.04, right? Divided by my KE. I don't know KE now. Okay, how do you find KE? KE by beta. Sorry, KE by CAPM equation. So, return market rate of return is 11% minus 9. So, 6 into how much? 1.2 is my beta plus 6. So, my KE is 12%. 12 minus 4. 8. Okay, 8%. So how much did we get? 8 was my dividend paid. Okay, 8 into 1.04 divided by 8%, right? So I'm getting it as 104, right? If I want to take it for total form, how will I do it? I'll take total 80 crores. I'll take total 80 crores. Okay, 80 divided by 8%. So I'm getting it as 80 into 1.04 divided by 8%, right? I'm getting it as 1040, right? Next, they've asked us book value. So how do you find book value? Just normal book value. How much is it? The shareholders fund is 450 crores, no? So we'll take normally, okay? What is book value? It is equity shares plus reserves and surplus, right? So they are given shareholders fund. So 450 crores. Shareholders fund is what? Equity plus reserves and surplus. So I got 450 crores. Okay. Next, they are asking net realizable value method. Okay. What is net realizable value method? It is book value plus your what would fetch more. Okay. 200 in case of liquidation, the building would fetch 200 crores more. Okay. I'll add 200 minus my stock would realize 50 crore less minus 50 crores. Okay. I'm getting it as 600. Okay, by realizable value method, I am getting 600. Very much easy question. Just keep your concepts in mind. Next, fourth. Fourth is a good question. Okay, there is some adjustment here. We'll see what it is. ICL is proposing to take over SVL with an objective to diversify. Okay, with an objective to diversify. So, who is proposing to take? ICL is the proposing to take SVL. Okay. So now they have given here ICL's profit after tax is grown at the rate 18%. Okay, ICL is the company which is taking over, and which company is about to be taken over? It is SVL. SVL's PAT is grown by 15%. Okay, they have given here growth percentage. Both the companies pay dividend regularly. The summarized P&L is given here. Okay, and the question goes on till here. Okay, don't be afraid of the question. Okay, it is very much easy question. We'll see. They have given here particulars of profit and loss. Balance sheet is given here. Market price is given here. Okay, now we have to read this. ICL's land and building are stated at current prices. Okay, ICL means what? The company which is taking over. SVL's land and building are revalued at 3 years ago. SVL is the company which is about to be taken over. Okay, are revalued 3 years ago. Land and building. There has been an increase in 30% per year in the value of land and building. Okay, what adjustment it is, we'll see. 30% per year, there is an increase. The land and building was valued 3 years back. Okay, so it increases 30% every year. Okay, so what it is, we'll see next. ICL's management wants to determine the premium on shares over the current market price which can be paid on acquisition of SVL. Okay, so it is asking that they are going to use market price. Okay, market price method only, but they will give some premium percentage. Okay, they will adjust some percentage to it. So should they buy it for 75 or should they give certain premium to it? Okay, we'll see what. First, they have asked us to determine the premium using net worth method. Okay, so what they are using firstly it is market price method only. Okay, now we are just finding the premium. Okay, so first is net asset value method, adjusted for current value of land and building plus estimated profit after tax for the next 5 years. Okay, so we'll see how to do it. The first thing they have asked is net worth. Okay, first we'll take net worth. What is net worth? Net worth is equity shares plus your reserves and surplus. Okay, so for SVL, what is my equity shares? Equity shares is how much? 125 plus my reserves and surplus is 660. Okay, so 785 is my net value book value method. Okay, net worth book value method, adjusted for current value of land and building plus, okay, current value of land and building. We have to adjust it because land and building was valued 3 years back. Okay, we have taken this amount. Okay, but this is not true. Okay, because we can take also another method. Net worth method can also be found out by another method, that is total assets minus your current liability, right? But what they are saying is that the fixed asset is not, that is your land and building, is not valued at the current market price. We have to take it at the current market price. So how do we take it? It is 190, right? So it was valued 3 years ago. Now we have to find it for current year. But see, here they have given here that the land and building was valued 3 years ago, but it increases 30% every year. Okay, since it was given 3 years back, so you have to take future value of it. Okay, so how do we do it? Future value 30% for how many years? 3 years. It is coming as 2.197. 2.197 into how much? So I have taken this amount into my 190, right? It is coming to 417. Okay, this is the current value. Now what we need is that we need only the addition value. Okay, how much will we add to it? Minus 190. So I'll add 227.43, right? I'll take this amount. Adjusted for the current value of land and building plus estimated average net profit for the next 5 years. Okay, we'll take this amount. Okay, and we'll take 785. That is your book value. Okay, now plus estimated profit after tax for the next 5 years. Okay, for the next 5 years. Profit after tax. What is my profit after tax? It is 250. Right, my profit after tax is 250. We have to adjust it for what? For the next 5 years. Okay, it will be less. No, sorry, it will be, we have to do future value annuity factor for the next 5 years. Okay, so this amount will take. Okay, So my 250 will grow by this much amount into 7.7537. Okay. So it is coming 1938. Okay. Should we M plus it? Business suka business suka. Now this is for total 5 years. Okay, we just need for 1 year. Okay, so we do it for 1 year only, divided by 5. Okay, this is very much important. Okay, since we are taking an average for 5 years. Okay, not the total 5 years value. Okay, we are taking average for 5 years so that we can get current value. Okay, in our example, what happened, Alex? Tata Motors wanted to find out the earnings capitalization, right? So earnings value, how much is it? So taken for the next 5 years, it will grow, right? So we are taking just average of it. Okay, so we'll do M plus MRC. We are getting it as 1400.115. Okay, so what did we do? We took share capital plus reserves and surplus. Okay, now we have to do adjustment. Okay, increase in value of land and building. Okay, book value of land and building, we minus it so that we get total amount. Okay, since the face value is, the book value is already included here, and we are taking what? We are taking the addition value of it to be added. Okay, and we are taking profit after tax for next 5 years, that is the average value. Okay, we did, and now what we have to do is that we have to find per share value. Okay, so that we are able to find the premium, how much we are giving, divided by what is the per share value. It is how much? 125, right? The paid up share capital is 125, divided by how much is it? 10. So 125 divided by 12, 125 divided by 10 is 12.5, divided by 12.5, right? So I'm getting it as 1.112.0092. Okay, minus what was my extra amount? What is my market value? It is 75. So how much premium am I willing to? I have to give? It is 37 rupees. Okay. Now if you have to take it in percentage, we'll divide it by 75. Okay. So I'll have to give how much premium percentage? It is 49%. Okay, 49% premium percentage I have to give. Next, the dividend growth formula, assuming SVL is expected to grow 18% each year after merger. Okay, now we have to do dividend growth model. What is the dividend given? It was 125. Okay, 125 into how much? 18% every year, no? Into 1.18. So I'm getting it as 147.5. Divided by what? Divided by KE minus G. What is my KE? Is KE given here? KE is not given. See, another thing, why did we take average profit for the next 5 years using the 15%? Because SVL grows by 15% every year. Okay, its PAT grows by 15%. Since we are taking profit after tax up for the next 5 years, it grows by 15% every year. Okay, so we are taking this. Okay, this table. Now we are doing KE minus J. So 147 was my D1. What is my KE? KE is, how can we find the KE? Is there anything given here? Since there is no CAPM equation given here, we will find it out by this method, D1 upon CMP plus G, right? That was my second priority in our notes. Okay, so we'll use that method. So D1 is 147 only, divided by CMP. What is my current market price? It is 75, right? Divided by 75. Okay, so what is the growth percentage? Growth percentage is 15%. Now here what growth percentage will we take? It is assuming that SVL will expected to grow 18% for the next year. Okay, after merger it will grow. Okay, that we are not taking here. Okay, while doing KE, what we do is that we take D1. D1 as what? By using the current growth. Okay, 125 into current growth. Okay, what is the current growth? Current growth is 15% into 1.15, right? Divided by my CMP, current market price. What is my current market price? Okay, this is in total amount, no? We'll take for per unit amount. Okay, 125 is total amount. 125 divided by how much we took. It is 12.5, right? 12.5. We are getting 10 rupees as dividend into how much? 1.15, right? Because it is growing at 15%, right? It is growing at 15%. Okay, to 1.15, it is 11.5 divided by my CMP. It is 75 plus my growth plus into 100 plus 15. Okay, so I'm getting it as 30.33 as my KE. Okay, so now we'll find it out. Okay, what is KE minus G? How much will I grow? Minus 18, right? I'll do it M plus. Okay, so how much was it? Was the D1? D1 was 125. We'll take total amount now because we have to find the value of the firm. Okay, or else we can take a normal also. 10 into 1.18, right? So 11.8 divided by I'm getting it as 95.67. Okay, 95.67 or 68. Okay, I'm getting. Now, how much premium am I paying? Minus 75 divided by 75. I'm paying only 27% premium. Okay. Next, ICL will push which method during the course of negotiation? During the course of negotiation, which method he will push? Which is in which he has to pay less amount. Okay, less premium. Since the dividend growth is he's paying less, 27% only. So we'll select that. During the course of negotiation, ICL will push forward valuation based on dividend growth method as it will lead to least cash outflow. Okay. Next, question number 5. Only 2 more questions are left, I guess. 3 more questions. 2 questions. Okay, Eagle Limited reported a portfolio of 77 lakhs after 30% tax for the financial year 24-25. Okay, it is profit after tax is given here. Okay, an analysis of the accounts revealed that the income included extraordinary items of 8 lakhs and extraordinary loss as 10 lakhs. The existing operations except for the extraordinary are expected to continue in the future. Okay, it is like an example only. Okay, of Tata Motors. The Tata Motors had extra, that it sold some profit, sold some asset. Okay, so it got extraordinary profit, and fire had occurred, it got extraordinary loss. Okay, in addition, the results of the launch of new product are expected to follow. Okay, we'll take now. Then what did Tata Motors do? Tata Motors said that it is going to launch a new car and it will have the following profit. Okay, it will have the following sales. So what did Alex say? Alex said that we'll take profit of it only. Okay, so we'll deduct all the material cost, labor cost, fixed cost. Okay, and we'll take profit of it. Okay, so now what they are asking is that calculate the value of business given that the capitalization rate is 14%. So after we get the we'll adjust all of this and we'll get a profit. We'll divide it by KO. Okay, they have given the KO as 14%. Okay, so we have to find it now. Now they are given here is that profit after tax is 77. Okay, we'll anyway have to deduct tax, but since 77 lakh includes this amount, which amount, extraordinary amount, we will take pre-tax. Okay, so 77 into pre-tax. Okay, if 77 is 70%, so what is 100 into 100 divided by 70, right? So my earlier amount will be 110 lakhs. Okay, minus my extraordinary income, it is how much? 8, minus my extraordinary loss plus 10. Okay, so it is coming to how much? 112. Now this 112, what we have to do is that we have to add this also, new product also. Okay, we are adjusting that also. Plus 70 minus 20 minus 12 minus 10. Okay, I'm just taking the profit of it. Okay, it is coming to 140. Now this 140 we have to deduct tax now, minus 30%. Okay, it is coming to 98. Okay, divided by how much? 14%, right? Divided by 14%. So I'm getting it as 700. Okay, 700 is the value of business, 700 lakhs. Now next, determine the market price per equity share with Eagle Limited share capital being comprised of 1 lakh. See, now what they are saying is that determine the price of equity. Now what we have taken is that we have assumed that PAT is my EAES, okay, earnings available to equity shareholders. But now what they are saying is that it also has the preference share rules, 13% preference share, okay, and 50 lakhs equity shares of 10 each, P ratio being 10 times. Now they are saying is that market price we have to find. Okay, P ratio is given, P into EPS will get market price. So how will we do it? 98 was the total amount of the PE, right? So 98 was the profit. So 98 was the total earnings available, right? So divide by the total number of shares. What is the total number of shares? It is what is? It is in lakhs. No, we'll take it in lakhs. Okay. Divide by how many? Sorry, minus what? Minus my preference shares. Okay. How much is it? 1 lakh preference shares into 100 into 13%, right? So minus 13 lakhs we have to do. Minus MRC. Okay, now this is the earnings available to equity shareholders. Divide by equity shares. It is how much? 50 lakhs. Now what you have to find is we have to find market price. Okay, now we can find it into P ratio, right? Into 10. So I'm getting my market price as 17. Okay. Okay, it is matching with the answer. So we are going right. Okay, this was fairly an easy sum. Okay, you just have to follow the concepts. Next, H Limited agrees to buy over the business of B Limited effective 1st April 2025. The summarized balance sheets of H Limited and B Limited are as on 31st March are as follows. Okay, so now what is it saying is that they have given the balance sheet here. Okay, so now H Limited proposes to buy out B Limited, and following information is provided to you as part of the scheme of buying. Okay, following information is given here. H Limited is buying B Limited. Okay, now the weighted average post-tax maintainable profits of H Limited and B Limited for the last 4 years are 300 crores and 10 crores. Okay, now what they have given is that weighted average post-tax. They have already given average. Okay, post-tax maintainable profit. So what did we find in earnings capitalization method is that we found future maintainable profit. Okay, they have already given us maintainable profit and they have given weighted average also. We do not have to do anything. Okay, this is the earnings maintainable for the future. Okay, so now what we have to do is that we have to just do capitalization now. Okay, so both the companies envisage a capitalization of 8%. Okay, 8% is the capitalization rate. Next, contingent liability is given. Okay, all this information is given. We have to give. You are required to arrive at the value per share of both S Limited and B Limited under the net asset value method. So what is net asset value method? Net asset value method is your total, your net assets. Okay, equity plus reserves. Okay, minus your contingent liabilities. Okay, in our example we we had no contingent liability was what? Contingent liability was the court case. Okay. That is, the Tata Motors was about to lose it. Okay. So we will less it, no, because in future they have to pay it. So we will take that also. Okay. So now what is given here is that equity shares is given. Okay. And reserves in surplus is given. So now what we have to find it is that we have to arrive value per share of both H limited and B limited. Okay. We have to choose to value per share. So how will we do it? What is the value? What is the total number of shares? For value per share, we need total number of shares, no? So 350 divided by how much? 100. So I'm getting it as 3.5, right? 3.5 crores number of shares. Now what we have to do is a net asset value method. So net assets, how much? 1300 minus contingent liability. Is there any contingent liability? Okay, here it is given as H limited has a contingent liability of 300 crores. Only H limited is having minus 300 divided by how much? 3.5. I'm getting it as 285.714. Okay, so this is my value per share as per net asset value method for H limited. For B limited, how much will it be? What is my net assets? It is 6.5 plus 225, right? Resources and plus is 25. Okay, how much is my equity shares? It is 6.5 divided by 10. It is 0.65. Okay, so 31.5 is my total value divided by 0.65. So what is the value? It is 48.46. Okay, it is 48.46. The value of equity share of B limited as per net asset value method. Now next we are doing is earnings capitalization method. What is earnings capitalization method? It takes future maintainable profit divided by capitalization rate. Okay, so 300 they have given in question already, divided by 8%. Okay, divided by 8%. So I'm getting it as 3750. Okay, divided by my number of shares, it is 3.5. Okay, I'm doing it for S limited. It is 1071.43. Okay, next we have to do it for H limited, B limited. Okay, so it is given how much? 10% future maintainable profit divided by capitalization rate, which is 8%. Okay, divided by how many shares? 0.65, right? So I'm getting it as 192.31. Okay, now next what they have given is that exchange ratio of shares of H limited to be issued to the shareholders of B limited on a fair value basis, taking into consideration the assumption mentioned in point 4 above. Okay, now we have to find the exchange ratio of H limited and B limited. Okay, so they have given some condition here. We'll see what it is. H limited to issue shares of 100 each to the shareholders of B limited in terms of exchange ratio as arrived on a fair value basis. Okay, issue shares of 100 each. Okay, H limited wants to issue shares of 100 each to B limited. H limited is taking over B limited. Okay, now they have to be arrived at a fair value. Okay, how do we arrive at fair value? They have given here. Please consider weights of 1 and 3 for the value of shares arrived on the net asset basis and earnings capitalization methods effectively for both H limited and B limited. Now what they are saying is that take weights. Okay, we have to do average now. Okay, now they have given weights. One weight is to be given for net asset value method and 3 weights is to be given for earnings capitalization method. Okay, now what we have to do is that we have to find value. Okay, value per share. So how will we do it? We'll take one weight of net asset value method. Okay, so how will we do it? 1 into my earnings. See, H limited, how will we do it is that for finding H limited value, 285, I got it in what? I got it in net asset value into 1 weight I gave. 3 weight I gave for this thing, what? Earnings capitalization, divide by 4, because we have to take it for 1, no, for 1 what it is we have to take it. Since they have given too much, we have to take it for 1. Okay, so how much will we get? We'll get 875. Okay, next for B limited also same we do. Okay, 48 for net asset, 192 for earnings capitalization, divided by 4, because 1 into 3. Okay, 1 was for net asset, 3 was for, we are just taking weight for 1, so that's why it is coming this much. Okay, now how much will H Limited give? Okay, how much will it give? So for 156.3475 divided by how many shares of H Limited? So for what basis are we taking? We take it in the denominator. Okay, so divide by 875. Okay, so for 0.178 shares of H Limited, shares 0.17 shares of H Limited, I'll give shares of Y H Limited. For 1 share of B Limited, I'll give 0.17 shares of H Limited. Okay, we can do reverse also. Okay, so 156.3475 divided by 875. Okay, sorry, 875 divided by. So 5 shares of B Limited can be given for H Limited. For 5.59 shares, 1 share of H Limited will be given divided by. Okay, we'll get the same only. Okay, so who is taking over, we'll take it in the denominator. Okay, so this forms the part of our first lecture, okay, of business valuation. Next lecture we'll see cash flow method. Okay, so I hope you have enjoyed it. We'll meet in the next lecture. Till then, tata, bye bye.